Financial history rarely unfolds in straight lines. It moves in cycles: expansion, confidence, excess, and adjustment. As 2026 unfolds, global stock markets sit near historic highs. Major indexes reflect years of growth, innovation, and sustained optimism. Artificial intelligence, automation, and productivity gains dominate headlines. On the surface, the system appears stable. But history suggests that moments like these are worth examining carefully. This is not a prediction of collapse. It is a historical examination. An attempt to place the markets of 2026 within the long patterns that have defined financial cycles for more than a century. Chapter 1: Confidence and the Illusion of Stability. Markets rarely fall during moments of fear. They tend to decline after long periods of confidence. In 1929, industrial America believed growth had become permanent. In the late 1990s, technology promised a new economic era. In the mid-2000s, financial innovation was said to have eliminated risk itself. Each period shared a common belief: that the system had evolved beyond its past limitations. History shows that confidence alone does not cause crashes. But sustained confidence, combined with excess, often precedes change. By 2026, economic data still appears broadly supportive. Corporate profits remain elevated. Employment remains resilient. Central banks communicate stability. These conditions have historically existed not only before continued growth, but also before major reassessments. Chapter 2: Valuations and Expectations. By historical standards, many markets in 2026 remain expensively valued. Price-to-earnings ratios across key indices sit well above long-term averages. Entire sectors are priced not on present profitability, but on future expectations. This does not imply immediate danger. History shows that high valuations can persist for years when innovation and earnings growth continue. However, valuation has never been about timing. It is about fragility. Markets priced for perfection tend to react disproportionately to disappointment, even when that disappointment is modest. Artificial intelligence has become a central focus of modern optimism. Capital flows reflect long-term productivity narratives rather than near-term cash flows. History offers many parallels where transformative technologies reshaped economies, but not without periods of correction along the way. Chapter 3: Debt as a Structural Constant. Modern financial systems are built on leverage. Governments borrow to stabilize growth. Corporations refinance to expand. Consumers rely on credit to smooth consumption. By 2026, global debt levels remain historically high. What history emphasizes is not the existence of debt, but its sensitivity to change. Periods of low interest rates reduce pressure. Periods of adjustment expose vulnerabilities. When refinancing becomes more difficult, risk is not reassessed gradually. It is reassessed collectively. Debt does not unwind slowly under stress. It tightens liquidity. It amplifies small shocks. It forces decisions. Chapter 4: How Market Corrections Actually Begin. Crashes are rarely triggered by a single event. They emerge through reassessment. Growth expectations soften. Liquidity conditions tighten. Confidence shifts incrementally, then suddenly. In modern markets, structural features accelerate this process. Automated trading amplifies movement. Leverage creates forced selling. Risk models respond simultaneously. From a historical perspective, downturns are not driven by panic alone. They are driven by synchronization, many participants reacting to the same signals at the same time. This is how ordinary corrections can deepen. Not overnight, but all at once. Chapter 5: The Repeating Cycle. Every market cycle produces the belief that lessons have been learned. Regulation improves. Risk management evolves. Institutions adapt. And yet, history shows that while systems change, human behavior remains consistent. Optimism expands during growth. Risk tolerance increases quietly. Discipline fades gradually. Corrections do not exist to punish innovation. They exist to realign expectations with reality. Some adjustments are mild. Others redefine eras. Closing a long-view perspective. Will 2026 mark the beginning of a major market decline? History does not offer precise predictions. It offers patterns. Periods of elevated confidence, stretched valuations, and widespread leverage have often preceded moments of adjustment. Sometimes those adjustments are shallow. Sometimes they are not. From a historical perspective, the more important question is not whether markets will correct again. They always do. The question is how investors, institutions, and systems respond when confidence begins to shift. That response has always shaped what comes next.